Hey guys, um, how you guys doing? I hope you're having a very good weekend. Um, I was going through my page and I wanted to do something a little more educative for you guys. I observed that I haven't done any video on market structure, and I feel that's a very important part of trading that you need to have as a beginner trader. Whether you're a beginner, you're an advanced trader, you need to know market structure to be able to make consistent gains in the market. So let's do something on market structure real quick so that it can add to your arsenal. So whether you're a new trader or you've been trading for a while, you are always hit with the reality of the market movement, either up or down. And so it's either a confusion or an understanding of how the market moves depending on your level of experience in trading. So you always come to the market and you see it go up, down in different directions. Sometimes it goes to the side, sometimes it goes down, sometimes it goes up. This is basically gold chart. This is gold 4-hour time frame chart. So I'm just using to explain what I mean by market going up and going down. So if you observe from the left to the right, you can see that it has been steadily increasing from this portion. So this is the upward movement I'm talking about. So and if you go further, you can observe that it also still came down as well at some point, then started going back up. So this movement, is there a way we can understand it? That's the question. Is there a way we can understand the rhythm of how this market flows? And it's very important to have the understanding of it. That's the honest truth, because if you don't know how the market flows, it means you're just swimming in a very deadly ocean. So when I mean deadly ocean, I mean you tend to lose money when you take a trade on the market because you don't know the direction the market is actually going. So in today's video, we're talking about how to be able to properly read the direction of the market. So how does the market move? Now, for a basic understanding, there are three types of market movement. Upward, downward, and sideways. These are the three types of market movement that is in trading. Now, the exception to this explanation is this: the market doesn't just move in a straight line. The way I drew it like this, it doesn't move in a straight line. It moves in waves, and that wave that it does move in is what now makes it have market structure. Now, this upward movement, this is exactly how to move going upward, so not in a straight line like I drew earlier. Then the downward movement, this is exactly how to go when it's moving downward, not in a straight line. So upward movement, downward movement. Then the sideways movement, something like this. So now that we have established this understanding that it doesn't move in a straight line, what you should now get is the names of these market structures. First and foremost, to the left, we have the bullish stroke uptrending market structure. Then secondly, we have the bearish. Then the last but not the least is what we call a ranging market. So these are the three types of market structure that exist: the bullish uptrend, the bearish downtrend, or the ranging market structure. So now, how do we identify when a market is uptrending and when a market is downtrending, or when it is ranging? So for the first one, the uptrend or bullish trend, the characteristic of the uptrend or bullish trend is what we should first deal with. Now, what are the things you need to see on the chart for you to now be sure that, oh, this market is in an uptrend? For example, we have a starting point in the market, point A, and market move from this point A to point B. We can't call this an uptrend yet because we are not certain of the direction the market is taking. Now, what will make us call this an uptrend is when we now start seeing some characteristics that are peculiar to uptrends. Now, this point A, there's a name we call it. Because it's at a low point, lower than B, obviously, we are naming them in relation to themselves. This A will now be called a low. That's a lower price than B. So A will be regarded as a low. That's a lower price than B. Then B is what? Obviously a higher price. So we can call B a high. If the market moves from this low to this high, we can say it increased in price. Why? Because the initial price that the market was when it was around this low, if you look to the right, you will see it is 4,883.38. If you now compare it to the price that it got to around this portion, obviously the price here is higher than this price. This is 4,891.17. It's higher than 4,883.38. Obviously, there's an increase in the price. If the market continues from this new high, that's this new point, if it reduces in price to somewhere around there, if it doesn't go below this initial low but closed around this point, then from there takes a new journey to create a new high, a high that is higher than this particular price here. We can call here for now point C, while we call here point D. So if the market moves from this low to this high, then retraces, that's have a pullback into this C, but doesn't go beyond the C, then from there it turns around again and goes above this high. In relation to themselves, C is obviously lower than D. Look at the price number, look at the price value. C is obviously lower than D. C is 4886.39, while D is 4894.84. It means D is higher than C. Obviously, yes, D can be called a high, while C can be called a low also. Why? Because comparing them to each other, D is higher than C. Fine, that means we can call this a low and a high. But listen carefully, because we already have a low here and a high here before, there will be some confusions if we say we want to name them like this. So we have to just give it like a new tag. Now, this low, if you compare this low to this other low here, what can we say? Obviously, this low that is here is on a higher price. Listen carefully. This low that is here is on a higher price compared to this low that is under here. The low here is 4886.28, while the low here is 4883.38. Obviously, this low is higher than this low. So, what will we call this low? This low is a higher low because it is higher than the previous low that was existing. Now, the same thing applies to the high. If you compare this high to the initial high that was formed before, which of them is higher? It's obvious. This high that is here is higher than this high that was formed previously. This high is going to be called what? A higher high. If the journey continues and we still have similar movements again reoccurring, something like this, for example, how do we name this price behavior? It's the same thing we are going to do. Like I said, this point, if you compare this point to the last point that was created, it's obviously higher than this last low. This is a low also. Why is it a low? Comparing this place to this high that is created here. Now, how do we label E and F? Obviously, E is lower than F. So, we know that E is a low. It's clear because of how we have been labeling it in the past. E is a low, while F is a high. But the issue now is, what type of high is this? Obviously, it's a higher high. I know you will start thinking in your mind that why is it not called a higher high, because we don't want to make it the same thing with this one. But if you keep calling it a higher high, guess what will you call this point? A higher high. You see the concept? So market can definitely keep going higher and higher, giving you new highs consecutively. So how will you start naming all this? That's why we just stick to the idea of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. You get the concept now? So we don't try to stretch it more than higher high, higher low, just because of repetition's sake. So this will be called a higher high. Why this is going to be called a higher low? Same thing will be called a higher low, while this will be called a higher high. So I hope that is clear. So this is for a bullish structure, for you to determine the type of trend you are in. In an uptrend, you have to see consecutive higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. Once you have seen a high and a low, and you see a higher low and you see a higher high, you are already in an uptrend. For a bearish trend, we have established that the market is going down, and we have agreed that it doesn't just go down in a straight line, it goes down in waves. So like I said, we start from a point, it goes from this point to this point on its journey downward. This will be called point A, while this point B. Obviously, point A is higher than point B, 490.39 compared to 4901.76. Point A is of a higher value than point B, so this will be called what? A high. While point B will be called what? A low. That's easy, no problem. Now, what if the journey continues? We continue seeing the market creating new lows. At this point, how will we name these two pivot points, this point to this point? Obviously, we can, just for ease of understanding, we can call it C and D for now, until we can establish the name. But if you go deeper, you can see is that comparing C and D, is one of them that is higher than the other. C is obviously higher than D, 4906.47 compared to 4898.57. So it means our C will be called what? A high also, while our D will be called a low. But if you look at it, like I said, we have something called a high already and something called a low already. So how do we differentiate the both of them? Like I said, since this is the starting high and low, this has to have a new name in comparison with them. So if you look at this high and this previous high, which one is higher and which one is lower? The values will tell you. If you look at this point and you compare it to this pivot point here, this pivot point here is at 4906.47, while this one is at 4908.34. So this is lower than this, so this will be called what? A lower high. This is the previous low, while this is the new low. So comparing the previous low to the new low, what will we call the new low? Obviously, the previous low is higher than the new low, so the new low is what we call a lower low. I hope that is clear. I believe it is clear. Now, if the market decides to continue that wave, then how do we label it? A high, a low, a lower high, a lower low. This will now be what? It's simple. Comparing this to this, we have what here? This is a high compared to this low. So this is meant to be a high, but it's meant to be a lower high. So this will be a lower high, while this will be a lower low. Then the labeling continues. Lower high, lower low, lower high, lower low. So this is what you have for a downtrend or a bearish trend. For an uptrend, for a downtrend. So for an uptrend, what you do is you buy in an uptrend. What do you do in a bearish trend, in a downtrend? You sell. Now let's go to the last of them, So in a ranging market, I told you, what do you see in a ranging market? I told you it moves to the side, right? It just goes up, down, up, down, up, down, up, down. So there is really no defined direction in a ranging market. As you can see, for an uptrend, we can determine that the direction is facing up. For a downtrend, obviously it is facing down. But for a ranging market, it's just going sideways. We can't label anything here. Why? Because we are just having equal lows. This is a low. Yes, we agree. Yes, it's going to be a high, and so on and so forth, because the price are literally on same value. Because of they are having the same values, we can call them equal highs. Then same thing with lows, equal lows. So you are buying in a bullish trend, you are selling in a bearish trend. What are you doing in a ranging market? Nothing. You are waiting. Now, what are you waiting for? You are waiting for the breakout of the range and a continuation in a particular direction. Whether the market wants to break above and start a bullish trend, or break below and start a bearish trend. So you are doing nothing in a ranging market, but waiting for the market to determine where it wants to go. Now, let's go to the chart and look for some of these examples. Right on our screen, what can we see? This is a very clear downtrend. Why is it a downtrend? Because we can clearly see a high here, a low, a high, a lower low, a lower 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 high, then a lower low. The same thing we did on our illustration. So this is what we call a bearish trend, because the market is going in one direction, downward. It's going in one direction, downward. Now let's look for a bullish example. All right, as we can see, this is also moving in one direction, upward. So if we are labeling this will be the low, this will be the high, a low, a high, which is higher than this high. So that's make it what? A higher high. This low is higher than this low, makes it what? A higher low. A new higher high, higher low, a new higher high. This is the higher low, not this. Why? Because this did not break structure to the upside like this did. A higher low, then this is the higher high. This is a bullish trend. Like I said, it's like the illustration we did, but there's something you should understand about the chart. The chart will never go in a straight diagram like we always illustrate in our explanations. Normally we can draw it as clean as this, but it doesn't happen this clean on the chart. Look at this and compare it to this. You see, it is still uptrending. Why? Because it's obeying the laws of an uptrend, having new higher highs and higher lows. But it's not as clean as this illustration. So take note. What you gotta do now is go back test and study this thing on your chart. Study how many times the market went on an uptrend, how many times it did a downtrend, how many times it did a ranging market. Let's go and check for a range. So for a ranging market, as you can see on the screen, the market just keeps going from this point to this point, back to this point, to this point, back to this point, to this point, back to this point. Basically, we can see that this is the box that the market tends to keep oscillating around. So in a ranging market, we can't see a defined direction. The market is just moving from the left to the right. Once you notice that the market is moving in a range, what do you have to do? Like I said, do nothing. Be patient and wait for it to break out of that range and start trending again, like it did in this case. As you can see, this is a range. Compare this to this. Very obvious. This is a range while it started trending back from here. So as you can see, it started from a range, then it broke out of that range and started trending back upward. So be patient enough to wait out this range and take advantage of the trend, either in a bullish direction, or if it chooses to do a breakout to the downside for a bearish trend. I believe with this video you have learned a thing or two about market structure, and you can be able to understand how the market moves in real time now. So I advise you that you go back, study your chart before you place any trade on your live account or even on your demo account. Study what I've taught on this video, then master it to the point where you can detect all the market structure that you come across. Because when you get to the main field, which is the live environment, you will be tested on your knowledge of market structure every day you come to this market. So please make sure that you have grown an understanding of market structure very deeply before you start funding your account to take any trades. I'll see you in the next video. I hope you guys have a good week ahead of you. If you have any questions, if you have any comments, you can drop it in my comments box. If you want to join my Telegram channel, you can hit my link in my description box. Please don't forget to subscribe to the channel, like, share the post to your fellow traders, and I'll see you in the next video. Take care of yourself. Peace out.